Good morning, and thank you for joining us for today's webinar. Just a couple of housekeeping items before we get started. We will send you a copy of today's presentation along with the link to the recording, so you'll have both of those. My name's Sean O'Brien, the president of QwickRate, and I am very pleased today to be joined by David Ruffin, who will handle the second half of the presentation today. David, as many of you may know or may not know, joined us in 2019 with the goal of developing a new credit intelligence analytical solution we call Telecredit. As you can see, David has a tremendous amount of experience in the industry, and we're very excited to have him. But we're even more pleased to have the new Telecredit division as part of the QwickRate family. So thank you very much to David for joining us. Some of the things we're going to cover here today, just a little bit of a look back at 2020. Certainly things are starting to improve economically. But I think more importantly, the second half of this, David's just going to talk a little bit about trying to uncover what the true state of credit quality is for a lot of us at our banks. And then we'll just show you some of the things that are new at QwickAnalytics and in Telecredit. So last year we have done these quarterly webinars just discussing where the economy was, what the impact of the pandemic was having. And really the center point or the ground zero for me was always just the Fed continually repeated the mantra that the path of the economy is going to depend on the course of the virus. And through 2020, certainly that was a lot more rocky. As we sit here at the end of the first quarter of 2021, it starts to feel like, things are clearly improving. Certainly parts of the country are opening up. I know in New Jersey and New York, we're seeing a little bit more of maybe a spike back up in cases. So, it is still a bit mixed, but the vaccinations are helping. So hopefully as we continue on through 2021, we can, start to see some improvement across the board. I think that, I've looked at this chart quite a bit. We've drawn a lot of comparisons to the last recession. I think this chart reflects just how dramatic the drop was from at this time last year into the second quarter, and how much the immediate response by the government and the Fed to get support into the economy rebounded in the third quarter. And then as that began to wane, we started to drop off, and now with a new round of support, stimulus, relief, however you want to phrase it, I think the economy needed it, and I think will help us avert what could be even more dire consequences. The GDP kind of reflects that, right? We saw a huge drop in the second quarter, huge spike up in the third quarter, and then we were starting to go back towards neutral. I think again, all told, the economy shrunk by 3.5% last year, and right or wrong, we could probably debate this till the cows come home, but I think we just have to get used to the fact that debt is going to continue to rise at the federal government level for an extended period of time. Last year, debt to GDP exceeded the size of the economy for the full fiscal year, which was the first time in more than 70 years that happened. I think there's a lot of talk now about the debt and inflation, but I think you have to solve one problem before you can start to solve the second one, right? And the immediate problem is getting the economy back on its feet, getting people back to work, and then we will, worry about the challenges of what the excessive debt and inflation might mean for all of us. I do believe at a time like this, the government is and government spending is the answer. I think if you look back and compare to 2008, in the last recession, it took almost 15 months to get funds into the economy. So there was a lot of needless deterioration because of the delay. This time we did it in almost 30 to 60 days, right? So the response this time, I think we learned from last time, there was no good that came from austerity measures or delaying relief into the economy. That's what the government's there to help do, is to bridge it when we have these difficult periods of time. But you can see here in 2020, it was a tremendous amount of support. So right, that can't be lost. It was huge numbers, but it's happening worldwide. So clearly wherever you look, and you compare to what happened last time, right? It is dramatic how much more government spending and relief support, stimulus, again, however you want to characterize it, is being thrown at trying to remedy the impact of this pandemic. As I mentioned, economic indicators are starting to improve. I think the biggest challenge right now are employment gains. They've certainly stalled or had stalled. Now they've picked up here in the last month or so. And then I think, as David's going to touch on, a lot of these challenges are the difference between Wall Street and Main Street, right? That if you think about it, I live in a small town in Illinois. Every time a small restaurant or shop closes, it's replaced or it benefits a larger company who's still there, right? And I think that's really the fundamental, or one of the fundamental issues that the pandemic has really raised, right? Is that the challenges, the impact, the severity of the downturn most disproportionately hits the people who can afford it the least, and that includes small businesses. And those are our borrowers, right? So we have to be cognizant of that. But certainly different areas of the economy have been very good. Certainly work from home type of businesses, technology have benefited from the pandemic, but anywhere where people need to gather, restaurants, travel, hotels, bars, restaurants, those things have all suffered and have not, certainly are still feeling the pains of the pandemic. CEO confidence is at its highest level, and on the flip side, consumer confidence is improving, but it's still remarkably low. There's a lot of talk about how much work the Fed has done in throwing money at the economy. The money supply growth, really, the growth is off the charts. But I think in the Fed's mind, at least it's certainly something worth watching, the velocity of the money is not. And that's typically what ramps up inflation. People are saving their money. They are paying bills. They're investing it. They're not spending it. And it's when you see that money gets spent and the velocity of it pick up is when you typically see inflation along with a decrease in the slack in the labor markets. We've seen neither of those two things, and I think those are some of the factors of why the Fed believes, while we're going to clearly have an increase in inflation, they don't believe it's going to get out of control. There at the end of the year, there were over 18 million people receiving some form of unemployment assistance, and as of end of February, we were still about 10 million people shy of pre-pandemic levels. And if you're the Fed, again, you have to think about what their mandate is. Their mandate is full employment and inflation. So they're going to work on both of those things. That's all they're mandated to do. So they feel like inflation's under control. They are putting everything they can to try to get people back to work. The employment increases, you can really see what the impact of the relief payments were and just support to the economy. We had huge spike ups, after the money got into it with the Fed's efforts. But as you can see, in the last 3 months of last year, we effectively created no new jobs in the economy. And I think that's where the Congress, the administration, the Fed, they all realized that the economy clearly had lost momentum and was going to need more fiscal support to get it going. The other challenging and concerning thing about the employment numbers as well, they have been continuing to improve. They have the number of long-term unemployed are high and have been still rising. I think it rolled over last month for the first time in a while, but I think that's particularly concerning just because, again, some people who might have lost jobs, will they be able to find a new job? Because again, many of this, in the aftermath of the pandemic, and David's going to touch on this, this has really been something that's ravaged by industry rather than something more generalized like a commodity like 1 to 4 family like we saw in the last recession. Specific industries have again been very, very hard hit. And it's unclear if some of those jobs come back, and then it's unclear if some of those people in those industries will be able to find comparable work moving forward. And so those are some of the challenges that kind of remain, and I think people are trying to figure out how to deal with them. Certainly nothing happens overnight, but we did learn from the last recession there's clearly more danger in doing less than more. The simple math, when you think about trying to recover jobs, if you're creating 200,000 jobs a month, it was going to take 4 years to get back to pre-pandemic levels. If you could increase that to 300,000 jobs a month, you're down to a little over 2.5 years. if you can get it up to 500,000 jobs, right? You're up to a year and you're down to a year and a half. And so those are all the kind of evaluations and measurements that the Fed is trying to do, right? They want to jumpstart the economy, get jobs created, and try to lessen the impact and the scarring that the unemployed workers and the economy are dealing with. So where does that leave us, right? I think certainly if you'd have told any of us that NPA numbers would have been better at the end of 2020 than to start, I think we all would have laughed earlier in the year. But the outlook has certainly gotten better, but it's still unclear in many areas. Q4 provisions were lower, particularly for the money center and regional banks. We saw a huge increase in the reserves in the first half of the year. They moderated in the third quarter, and some of the larger banks even drew back their reserves in the fourth quarter. So I think there's plenty of reasons to continue to be positive. The banks, as all of us as an industry, have a tremendous amount of capital and liquidity. Loan to deposit ratios are at decades low. There's a belief in an improving economic forecast, and in housing, clearly the source of most of the problems in the last recession has been a source of strength, not only for individual borrowers, but just in general. And then bank valuations are rising, right? We saw 40% declines in bank valuations last year, and those have all virtually recovered, and then the outlook is much improved for this year. So, again, a lot of positive signs. I showed this slide throughout last year just to kind of monitor where the reserves were going. You can see this is a page from our QwickAnalytics solution that just shows JP Morgan's loan loss reserves. You could see the tremendous uptick that they went from 9/30 of 29 to 6/30 last year, where they took their reserve up, over to 3% of loans. But it was a huge amount, and in their earnings reports, they attributed 75% of it to potential COVID losses and not CECL. So that was the big distinction. But they have moderated it some here in the last two quarters. It'll be interesting to see if that moderation continued here in the first quarter, which I suspect it did. As I touched on earlier, consumer confidence is rising, but you can see the huge drop it took in this time last year and hasn't really recovered much. But this is, undoubtedly important to, going back to the velocity of money, people are just not confident of where things are, and consequently, as a result of that, they are not spending money. To get the economy going, we're a consumer-based economy. We need people to spend money, and consumers do not spend when they're not confident. So this will be, again, interesting to watch to see what these numbers look like after the first quarter. But again, a slow rise, but just probably not enough. So I think it's a little bit of a fool's errand to try to be, to predict a lot of things. So I often just try to focus on trying to be directionally correct. And so, I'm clearly not smart enough to make predictions, but I think you can always see which way, or at least feel which way you think the winds are blowing. And so as if I think about this year, there's a lot of signs that are much more positive. As I think about not only our outlook, I'm a director in a small community bank in Illinois, how we're feeling about our market. But as we talk to bankers across the country, I feel directionally, much better than I did, say, a year ago. Now, that doesn't mean there's not still questions, right? Unemployment is still high, but it's improving. The long-term unemployed is not falling off. And again, Main Street is wounded. I know our small businesses, they're around, but they're hurting. And so, once some of the relief ultimately and eventually dries up, the healing will begin, but we really have to find out what the true state of our borrowers actually are. And so that's part of what 2021 is really going to be about, is digging in and trying to identify, emerging risk, or, risk that's kind of lying, beneath some of the relief that's been provided. I haven't updated these in the last month, but I felt like I was updating them every day. The GDP forecast for this year continue to improve by the day. I think these are probably all outdated because these are probably a month old now. But I think again it is indicative of the confidence that we're seeing, kind of across the board, that this is going to be a really strong year for the economy, and hopefully again makes it a good year for our customers and for all of us at the bank. That said, this is a slide from McKinsey, right? There's still a lot of work to do. I think state by state, I think it's, there's a lot of optimism. People are clearly getting vaccinated, but it is a big undertaking. And so to get to, the number of vaccines we need is a big, it's a monumental task. So, I think hats off to all the people who are working to make this happen, but, it still speaks to the problem that we will face in the first half and certainly throughout the year. So just to find, a few things before I turn it over to David. We always track at QwickAnalytics just information about banks. We're big believers in data. We want to do, and what we do is aggregate a lot of the data so our customers can analyze it and make their own determinations. But we always want to gather the data that we can. So the QCBI is our measure of community banks. It's based on the definition of a community bank by the FDIC. But we run these every quarter. They're available both on a state and national level. And so if we kind of look at the breakdown of banks in New Jersey, right, it's a smaller population that continues to consolidate, which makes it challenging. But you can see here the last 12 months of growth for loans, was not as high as you might expect for a lot of places in the country. This is median growth for the 52 banks. You can see it right about the national median. The red line is the national trend at right about 6%. You can see the breakdown. 38 or 20 of the banks had greater than 10% loan growth, but we had 12 banks representing 23% of the banks who didn't see any loan growth in 2020. Deposit growth, a lot of the PPP money, landed in banks, and you can see the impact of that again right at the national trend. And 65% of the banks in New Jersey experienced deposit growth greater than 10%. Some performance numbers. Yield on loans, is needless to say, with the precipitous drop in interest rates, that impacted us. We're margin lenders for the most part, so a big hit to the yield on loans. Cost of funds has come down nicely, still above the national trend, but we can see here at the far right with the impact that means to NIM. So we went sub 3% NIM for the median bank in New Jersey, which is a challenge, right? It speaks to the challenges you're facing. The cost of funds numbers, again, I think one of the, oftentimes we get windows of opportunity in crises like these. Obviously the wholesale fund market has dropped precipitously as well. So there is opportunity to get a little bit longer term funding at very inexpensive rates. You can get funding pretty inexpensively wherever. So, trying to kind of reshuffle the deck a little bit and take advantage of some of these opportunities is always worthwhile to look at, solutions like Quick Rate as well. Non-interest income stays well below the national trend, and the efficiency ratio ticked up, right? So, I don't have to tell anybody on the call, right? It's challenging and difficult times for banks in New Jersey, right? It's always tough, but just speaks to some of the challenges we're facing. Bank performance, just kind of a recap, 2020 versus 2019. 2 out of 3 banks essentially saw ROA decrease. Almost every bank saw asset growth. Better than 4 out of 5 banks saw a decrease in their NIM. And then, as I touched on, most banks saw a decrease in their loan to deposit ratios, but we really are at, decade lows for loan to deposit ratios. So on the one hand, right, it makes the system a lot safer. On the other hand, it doesn't give us the opportunity to drive as much earnings as we would like. And that comes up here when you see these ROA numbers, right? We've had a nice little run from 2015 to 18. We rolled over in 19, and now we've rolled over in 2020 as well. And again, these speak to median numbers. If you look at these by asset size, not surprisingly, the largest banks still are driving the best ROA. A little bit surprising that the $250 to $500 million banks had such a low ROA last year. And then we're big believers in core operating earnings. They're numbers that really represent kind of a pre-provision, pre-tax type of analysis. You can see those numbers roll over as well. And in the same way, the larger banks will continue to drive a good core operating earnings, but the sub 1% ones are certainly disappointing, and it speaks to the challenge. It's really hard to drive ROA if you don't have core operating earnings 1.5% to 2%. So again, just challenging times, even pre any potential COVID or credit costs. All right, so at this point, I am going to turn the presentation over to David and make him presenter. So if you can bear with me 1 second, and he is going to take you through the second half of the presentation today and discuss the credit uncertainties. David?
Yes, thank you very much, Sean, and certainly thank you to all the New Jersey bankers on the webinar today. I think, again, from a credit perspective, I will try to disabuse the audience of that. I'm certainly not gloom and doom, even though that kind of comes with the reputation of credit people, I guess, at some point. I think the real operative word here is uncertainty, and therefore requires vigilance going into 2021. So uncertainties, why? Sean has certainly alluded to a number of those factors, but I think it's worth kind of revisiting from a credit risk perspective. Certainly 2020, as again Sean alluded to, was really a high performance banking year unexpectedly. Virtually every bank outperformed expectations. The Armageddon that was feared at the advent of COVID just did not materialize. Credit metrics at 10,000 feet arguably imply almost nothing onerous has occurred. There's a lot of temptations to claim victory. We're just that good at managing our institutions through a national disaster and frankly making money in doing so. We are certainly the beneficiaries of years of building more capital since the last financial crisis. And again, with the vaccines coming, we all hope, of course, the worst is over. And again, unlike the decade ago, where we really did have one industry in many ways to blame, we also cannot be blamed in any way as an industry in this regard, because there's nothing, in fact, if anything, particularly the community banks have gained a lot of national plaudits for the aggressive stance the community banking space has taken with the PPP program. Now, as some of you may recall, the late radio and television announcer, editorial commentator Paul Harvey used to say when he would, pivot to the other half of his story, what is the other rest of the story? I think we experienced unprecedented regulatory relief, massive federal stimulus. We've had a flush of liquidity and non-organic loan growth through the PPP and SBA initiatives, which continue into 2021. I think, however, bankers know intuitively that credit tails, or the so-called impact of economic shocks, always outlive the shocks themselves. And we all know the federal government lifelines eventually will cease. As Sean alluded to, and I wrote an article just, I think it was in December, that may actually have been shared through the New Jersey Bankers Association, that our credit indeed lives and resides on Main Street, not Wall Street. And as we all know, Main Street is still in a recession. And, many of our, and this is a classic red flag from a credit perspective, many of our borrowers, frankly, are in survival mode rather than thinking of borrowing to invest in growth, which is, in a more normalized environment, is a much more healthy loan purpose. So credit realities that we have to continue to deal with is that all of these initiatives that have been alluded to largely by Sean, while clearly avoiding an economic calamity, have aligned, I think, to create what arguably could be said as the greatest masking effect of potential underlying credit risk in modern banking history. Again, we don't have just one industry to point to. This is perhaps one of the most vexing parts of the COVID or post-COVID world to bankers, is that we've got to start ferreting out different and divergent industries within our portfolio that might have been more impacted negatively, that we have to be on top of. Certainly 2021, I think, is going to be on the front burners of all the stakeholders of banking. Boards and management never like to be surprised or ignorant, if you will, of what's in the underlying portfolios. Risk managers, those of you that are in that role on this webinar today, that's your primary objective and purpose, is to be on top of risk. Certainly investors and investment bankers, that was part of some of the, I think, decline in the bank valuations is the, excuse me, the degree of uncertainty that seemed to be embedded in many of these banks' portfolios. And I've had investment bankers tell me directly that almost never in their career have they sensed so much uncertainty as it relates to that. And certainly regulators who, everything we're hearing, that there will be back in a more normalized regulatory approach, and there is strong expectations that there will be a lot of a need for banks to explain where they are in a COVID or post-COVID world. And again, we all know that uncertainty by its nature is anathema to managing credit risk. We can't eliminate it all, of course, but we certainly need to minimize it. And again, I think that's reducing these uncertainties is really the name of the game, priority number one for 2021 and into 2022. So other challenges remaining, we certainly still have instances, as we have heard, where there's increased investigations of some PPP fraud, perhaps an inevitability that is tying up some banks in terms of just administrative need to fuel that those investigations. CECL is not going away, despite the fact that some bankers had hoped that might be the first victim of COVID, but it clearly is not. And again, even though that it was extended for some of the less complex banks, it is still something that needs to be looked at and needs to be adhered to in an appropriate way and ready to be fully adopted. This is the year of LIBOR transition. The interagency released a guidance a month or two ago reminding bankers to be sure that all their documentation disclosures were in order in that regard. And of course, we constantly live with anti-money laundering, BSA, and cyber risk. And of course, the inexorable question is how long the tide of the government to frankly both abate our risk and enhance our growth, because I think, to be intellectually honest, everything Sean's talked about and everything I just alluded to is the banking industry to some degree has been either direct or indirect beneficiary of a lot of this government largesse. So let's take a look at what New Jersey looks like. We're going to use our sister division, QwickAnalytics, from this point on in the presentation to give you some comparative data on credit metrics, both at the state New Jersey level, the regional level, which is MidAtlantic, and the national level. The first diagrams here are really just this simple, what I call the trifecta of loan quality. One is on the far left is your inventory of problems, your non-performing loans. And then that kind of begs the question, what do you do with your inventory? You either charge them off or you reserve for them. In this case, New Jersey and the region, the Mid-Atlantic region, which you see the states below that comprise that. And again, in our world at QwickAnalytics, we tend to focus on the under $10 billion banks, and that this data is more meaningful to community and regional banks because of not meshing it in with some of the mega banks. And so, in this sense, New Jersey and the inventory is up slightly, but as Sean alluded to, nowhere near what probably people would have predicted last April or May. Charge-offs have not been consequential anywhere in the industry thus far, and typically for community banks, there have been some adding of reserves. Another way of looking at the inverse of this is that if you look at the Mid-Atlantic and New Jersey is slightly below the national average in an inverse way of looking at it. This is in effect saying that in New Jersey banks, you're just over 200 basis points covering all of your acknowledged problems at this particular point in time. Sean talked about loan growth. That's in New Jersey, largely coming from the greater than billion or the 250 to 500 $1 million banks. But if you looked at the chart on the right, and that's as of third quarter, you see a huge drop off. And again, a lot of that spike was PPP in the industry as a whole. But as we went into the third and fourth quarter of last year, we actually had, in many cases, negative organic loan growth throughout the entire banking industry, which is clearly depicted in that. And that's another issue we'll touch on just briefly in a moment. Concentrations is always an issue, I think, for banks to have to be sensitive to. And what tends to come to mind, of course, is real estate concentrations. That's the centerpiece of the interagency guidance during the mid-2000s. New Jersey's kind of got a kind of bifurcated look on that in construction development, which is the subset of the broader CRE, and that's, of course, guidance at 100% risk-based capital. New Jersey and the Mid-Atlantic are a little below the national average on that. There's only one bank in New Jersey that exceeds 100%. Remember, that's a guidance, it's not a regulation. The inverse is true, however, on the broader commercial real estate to risk-based capital, and that is that you've got higher than normal, both from a regional and a state level than the national average in those. There are 9 states in New Jersey that do exceed the 300% guidance, again, putting in more pressure on them to just not, it's not, again, a regulation violation. It's just saying, okay, can you give comfort to regulators or frankly investors as to why you would be exceeding that level in that concentration. Other concentrations that may come to mind, none of these are illogical for New Jersey, given the urban nature of much of your market. Obviously, multifamily is much greater than the national average in terms of the concentration. Again, the C&I in the middle chart is arguably funny money. A lot of that spiked by the PPP non-organic loan growth of mid-2020. And of course, irrespective of you being known as the Garden State, you really don't have a lot of ag farm concentrations in the commercial banking system. Of course, these numbers are not inclusive of the farm credit system. Concentrations are important to relook at because that we remember from the last crisis, like speed does kill. The FDIC commissioned an excellent study in mid-year last year, the findings of which were not in any way surprising to hardly any of us that follow credit risk and understand banking performance. But it basically did a post-mortem, if you will, on bank failures of the last crisis. And it came out with the findings that 70% of those bank failures had CRE lending focused concentrations, with high concentrations of late cycle, or what we call loan vintages, or late in a proving empirically once again that often loans made late in a healthy credit cycle can become some of your most toxic when credit begins to stress, which again, I think, credit risk manager needs to keep in mind relative to your own portfolios in that regard, and be able to understand where you sit relative to vintage and concentrations. It also proved the inevitable of why we moved 30 or 40 years ago into cash flow lending rather than collateral lending, that there was a high correlation to collateral dependence in these failed banks. And we all know that once you as a banker have to depend on collateral to get you out of a problem loan, you almost always are facing devalued collateral. So it's the worst of both worlds. And of course, there were state and regional market forces that proved to be critical covariants. For example, the Northeast really escaped a lot of the bloodbath that the Southeast incurred during the crisis of a decade ago. And many of these banks, failed banks, frankly, were in the Southeast or in the Western US. Again, one of the reasons why CRE is still important, this chart is as of 2019, and it's for all banking as a whole or commercial banking as a whole. But I would argue if that chart were true of just the more community banks, that dotted line, which is the CRE lending, will have surpassed residential lending a good bit ago. And again, you see where we were at the in terms of our dependence on CRE lending is even greater than it was during the crisis of a decade ago. And we all know that two particular subsets of CRE lending, whether it be retail portfolios or income property, office space portfolios, perhaps have been altered permanently and forever. Some of the trends in those were inevitably changing anyway, but COVID has probably exacerbated those significantly, and that we have to be aware of that. We do need to remind ourselves of the structural challenges associated with when credit does become stressed again, if indeed we still have residual aspects of COVID that begin to rear its head once some of the regulatory relief and the stimulus is over. I do think that, again, this has again been proven. There are three reasons for this. One, there's capital is always a factor in terms of dealing with problem loans or increase in problem loans. You've also got the subjective nature that most community banks in many cases literally know the borrowers personally in the community. And thirdly, most importantly, community banking still has a disproportionate focus on real estate lending. Arguably, no questions whatsoever, is the most illiquid of problem loans once it becomes an acknowledged problem loan. So it is always important to understand that. In this particular case, it's really in New Jersey, it's the 250 to $500 million banks that are still housing arguably, very low levels of problem loans, but at least at this stage have proportionally a little higher than some of the other size banks in New Jersey. So changes afoot in lending, and there are some changes that I think that are both from a production standpoint, and then we'll touch on the risks divide, which is obviously the classic divide in lending. And I think looking for the new prospective borrower, the pool of the traditional credit opportunity for bankers has really shrunk quite a bit. In other words, the organic loan growth targets have been changed radically by COVID for a lot of the things we've been talking about. So I think it's going to be important for banks to convert those PPP loans into more stable organic loan growth, capitalizing on the goodwill related to that, and in effect, helping to lead the COVID recovery. And any way you cut it, I see no reason why any bank should shy anymore from embracing government guaranteed loan programs, SBA and the like, mainly because that is likely to be the bridge as much as anything into your ability to take potentially the risk you're going to need to take credit-wise to convert some of that stressed credit into so-called organic loan growth or organic borrowers that you can defend. So I'm a big advocate of embracing that, maybe not any longer just treating it as a redheaded stepchild that sits over here in a different division in our lending, but to go wholeheartedly into embracing government guaranteed lending. It clearly has, again, attributes of helping you enhance your organic loan growth. It gives you continued goodwill in the marketplace. There is profitability from the fees and secondary market sales. Of course, that's all presuming the efficacy of the guarantee is in place. So from the risk perspective, the risk side of the equation, I think we're clearly have been pivoting from production to dealing with the modifications of last year. A second round of PPP we're dealing with. There may be some need down the road to assess talent relative to your specialized assets, so to speak, or workouts. That probably is going to have to occur throughout the banking industry a little bit in the next couple of years. And it is really a talent that is not heavily been needed or utilized in the last few years. Staying close to the borrowers. One thing specifically I would recommend is take a look at some of your policies and procedures. Remember, the regulators are charged, rightfully so, of holding our banks accountable for the practice that they operate under, the procedures or policies they claim they are. And sometimes we create inadvertently traps to fall in ourselves. And I see no reason whatsoever not to, at least on a temporary basis, modify some of your policies or guidelines relative to the COVID world we live in right now. And again, COVID is not the effect of credit in your portfolio is not going to end with the vaccine success. It's going to have some residual effects deep into 21, deep into 22, in my opinion, and that I think you're going to need to make absolutely sure you're not creating a trap again using policies that may have been written 3 and 4, 5 years ago in arguably very robust economic times. I do think focusing on conservatism without overreaction, particularly focusing on reserves. I think our whole industry, if we get a round of credit stress, is going to be far more reserve focused going forward, dealing with those stresses rather than the charge-off, the knee-jerk charge-offs we had to live with a decade or more ago. And I do think renewing a focus on effective substantive loan review is going to be critically important. Let's face it, a lot of loan review had to be postponed or narrowed in scope in 2020 for obviously logistical reasons. There's some catch up going on, and there needs to be, a very substantive focus on that, making absolutely sure you've got quality loan review going on in over your portfolio. I do think from an M&A standpoint, there will be greater activity. Certainly helped, as Sean said, by strengthening valuations in the banking segment. But again, getting over this unprecedented level of credit uncertainty is going to be an issue as M&A starts becoming more active, because in the end of the day, the value or discounted value of a credit portfolio still remains at the heart of a deal. And again, it's well beyond just one industry focus. So I do think that we'll be back into some M&A, but it'll have its own challenges relative to how we go about it. I will say in closing that there are 5 key strategies that we are recommending our clients at Telecredit to employ in 2021. Is first, recognize the trap of focusing only on your portfolio at large. That is, to use Sean's point a moment ago of a fool's errand, there are a lot of at-large kind of dynamics or metrics at the top of the house on your credit portfolios that really are like, fixating on the forest and forgetting, rot in certain trees. And my point there is, I think that is really one of the things that we're going to have to be accepting as an industry, is to not be entrapped by just focusing on the portfolio at large. Again, COVID has left us with a unique situation where we really need to be thinking for the next 2 to 3 years of how we subset or subdivide our portfolios into differing hotspots or segments, almost treat. And technology is available. That's what Telecredit was largely formed about, to give affordable, practical tools to community banks to give you the ability to subset your portfolios, identify these hotspots, almost treat these as separate portfolios, because we all know as credit risk managers is that there's a corollary between early detection of credit risk and your ability to minimize ultimate losses. There's no question that that's been an eternal proof in managing credit risk. Your ability to then quickly identify, drill down to troubled or stressed borrowers, in other words, get at those issues much quicker than later. As we just mentioned, adopt alternative portfolio servicing protocols, including enhanced loan review. And when I say enhanced loan review, make absolutely sure that whoever's doing your loan review is providing you with biographies or bios for their skill sets and their background. I'm going to be blunt here. The days of just having novice people right out of college that they may have a CPA degree or whatnot is not going to cut it, looking at increased levels of stress credit, because that may have sufficed during the good times, but the ability of loan review to be able to challenge assumptions, to be able to point to the internal processes of the bank to understand what the nuances of credit, I think clearly are important, at least for the next 2 or 3 years in this regard. And again, I think we use this term in Telecredit quite a bit, and that is particularly now that the regulators are going to be back in their normalized examination process, there's going to be huge incumbency on you to write your own script around what your own bank's idiosyncratic risk profile looks like before the regulator or anybody else outsider does it for you. So that's the nature of how we formed Telecredit. That's the philosophy of it. We obviously use public data comes from entities like QwickAnalytics, our sister division, but we take a kind of a top-down, drill down, peel the onion, whatever metaphor would be important. But I think one of the things we did in a revolutionary sense in Telecredit was we actually brought loan review out from the coal, a point-in-time engagement, to make it part of an interactive process of diagnostic portfolio analysis. And remember that only you have the ability to understand that kind of idiosyncratic loan level non-public information. Outside stakeholders, including for the most part or even regulators, look at you through public data. And it's that non-public information, that sense of where emerging credit risk comes from, that gives you a leg up, if you will, on making sure you're seen as ahead of the curve for whatever credit stress may come as a residual of the COVID environment. Again, that is indeed what Telecredit was designed to do and offers as we sit today. So in concluding, again, remain captain of your own ship. I think that's going to be quite important for you to be perceived that way. Regulators have told me they go in a bank and then leave a bank with kind of this kind of sense of were they cooperative and were they competent? Were they being bank management? And nobody would want to be seen in the red of either one of those axes. Minimizing credit surprises. I've been in this industry a long, long time. I don't know of anything that becomes more toxic in terms of a board management dynamic or a bank regulator dynamic than having too many credit surprises. There will always be some credit surprises, but the magnitude of those, it's up to the bank to ensure that they are minimal. And so I do think, again, as I alluded to, there is a correlation between the early detection and your ability to reduce the levels, and then as importantly, your greater flexibility to manage those problems out of the bank when there may still be time to do so. We think the magnitude of today's credit uncertainties adds to your challenge, but we certainly think they can be overcome. So, Sean, I will hand it back over to you, sir.
Thank you, David. And I think, again, if you haven't spoken with David, I think you can see and hear just through the presentation, why we're so excited to have him here with us, developing the Telecredit solution, because he just has a tremendous amount of knowledge, in the credit world. And so, again, certainly encourage you to reach out to him and learn more about Telecredit, or if you're looking for a loan review, to give us the opportunity to provide you a quote. So just a few things in closing. Certainly if you haven't looked at QwickAnalytics, just a reminder, we are an aggregator of publicly available information. Our goal is to make that information, easily available to you and for your team, easy to navigate and get at, and allow you to focus your time where we think it should be spent, on analyzing data and not aggregating data. Some of the enhancements we've continued to make and improve is we introduced the CECL solver a couple of years ago. We've continued to make improvements to that page. We have a CAMELS page that will be for any of the banks that are publicly traded or need an investor relations page to be compliant with SEC Rule 15C2-11. And then we've also had an Excel add-in tool, and we recently added credit union data to that, as well as a complete of what a page looks like. You can host it, or we can host it. We can support it. Again, all depending on what you're looking for. We introduced a number of years ago the portfolio level credit stress test. We enhanced that at the end of the year to make it more interactive. So we'd love to show you that as well. We give you the ability to make a lot of modifications, which is an improvement over the last offering that we had. As I mentioned, we have credit union data along with bank data in the add-in tool. And I think it really reinforces, or I hope you think it reinforces, really what we've tried to do over the years, not only at QuickRate, but then at QwickAnalytics and now with Telecredit. Technology doesn't help you if you can't utilize it or if you can't afford it. And so for us, our goal is to support community banks. We believe we've developed and built affordable, easy to use and implement technology solutions. The latest of these, which is Telecredit. So, if you haven't reviewed those, I'd encourage you to. As I mentioned, if you'll give us the opportunity to quote a loan review, we'll show you how not only the review process can be made more efficient, but we'll give you even more valuable for you as well. So we'd respectfully ask you to consider us. As I mentioned, Telecredit really is a twofold offering. One, it's a cloud-based application that includes an analytical tool. And if you're doing any internal loan review, you can utilize it for. We will also, if uses a lot. Using this allowed me to do my day job during the review. So again, I think just tremendous efficiencies from the people who know this area best. A reminder on QwickAnalytics, it's really broken up into 3 different areas. We have some interactive bank analysis. We provide a wealth of ways to do bank and peer performance, and then we've also developed some regulatory tools, including a CECL solver and a credit stress test. So certainly we want to be mindful of your time. I'm going to check for New Jersey bankers. We look forward to hearing or seeing you at future New Jersey bankers events. And I don't see any questions. So again, thank you for your time today. And please let us know if we can help or just give you a demo of anything we offer here at QwickAnalytics or Telecredit. And we'll look forward to seeing you on our next event. Thanks again. Have a great day and be well and safe. Bye now.